Welcome to today's webinar, everyone, where we're going to be talking about leveraging technology to improve cash flow and business performance. I'm joined today by two of our app partners, Xero and iwoca, and they will no doubt provide some valuable insight into the discussions today. As we build today's discussion, the focus is around the components of influencing cash flow for a business owner, but also how technology can help. And with the adoption of technology and with the AI boom on the horizon, ensuring that we're getting the most out of the platforms that we're using, implementing best practices and getting the most of the benefit from AI enhancements in the future. It wouldn't be a webinar without mentioning AI. So before we start, and as the final people kind of start joining, we will move on to the basic housekeeping and the agenda for today. So the session is being recorded and the webinar is scheduled to run for an hour. Questions are scheduled to be taken at the end, but if you do have questions during the webinar, please drop them in the Q&A box, and a copy of the recording and slides will be made available after the webinar if you do have to dash before we do finish the session today. In terms of the agenda, I will do some basic introductions. The team will introduce themselves. We'll break the components to improve cash flow down in your business and where technology can help as an enabler. And then we'll cover off the 3 steps to implement cash flow from those key takeaways in your business. And then, of course, there'll be some Q&As at the end. So let's jump into the topic of today, which is cash flow. And I think we're all familiar with the term or the phrase, cash is king. It's been around forever in business. But in an era today where we've got the existence of cash that's declining and more transactions are being made digitally, is this really still the case? And especially for business owners, it's not cash that is king, it's actually cash flow that is the lifeblood of businesses. So the amount of money that's flowing in and out of the business, which is very different to profitability. And Niall and I will touch on this later on, because a lot of businesses that are actually very profitable are actually cash flow negative. So with company insolvency up 17% in 2024, cash flow is a very topical area right now. But before we get into this, let's have some very quick introductions. So I'll be hosting today's session, and this is my first webinar for Gravita. I'm Russell, I'm Director of Transformation here at Gravita, and I lead the adoption and implementation of accounting technology with Gravita. I am a qualified accountant, and before I moved into transformation, I spent a lot of my time working with business owners, implementing new systems, technology, and improving and advising them on things like business improvement and cash flow. But that's enough about me. So as mentioned, I'm joined today by 2 of our tech stack partners. Both recently have been married, coincidentally, and not to each other, may I just add for that. So first, Kat, will you introduce yourself and I'll pass across to Matt to do the same.
Yeah, brilliant. Thanks, Russell. So I'm Kat Nelson. I'm a digital transformation consultant at Xero. Basically what that means is very long job title, but I'm a consultant that supports our businesses in using Xero. I use Xero as well. So prior to being at Xero, I've been here for around 3 years now, but prior to that I was in practice. And within accounts practice, I was supporting our clients with using technology and kind of getting the most out of it and helping them kind of transform from manual processes into that digital environment. But that's me.
Thanks, Kat. Matt?
Morning. Thanks, Russell. So as you can see on the lovely screen there, I'm typically much more smartly dressed, but I am the accountant channel team captain over at iwoca. So what that means, similar to Kat, nice long title for a fintech. I look after a team of relationship managers. We work with accountants, bookkeepers up and down the country, all across the UK, assisting them and their clients either take loans through iwoca or get paid quicker through iwoca Pay. My background, I've run a small business in France for a number of years. I'm from a farming family, wide and broadly across Essex and Norfolk. So I've grown up within businesses that have very little cash and very high cash requirements. And I spent a brief time in HR, Royal Forces in the Army. But today, just here to discuss finance. As you'd expect, it's a totally strategic and linear path for anyone to take into finance, from farming through the French Alps. I got lost somewhere as I came back to London, I think. Lovely to be here.
And last but not least, the voice of reason on this call, my colleague from Gravita, Niall.
Thank you, Russell. I don't know how I can compete with that, Matt, but I am an accountant. That's the first thing to say. I'm a partner in Gravita. I've been a partner for many years. I look after SMEs. I act as a finance director for my clients on many occasions. I have a team that work as their financial controllers or help with their financial all aspects of their financial work with my clients, big and small. And cash flow is very much at the moment the biggest priority I have to work when I work with my clients. And there are certain things that are easy fixes and certain things that are less easy. And I certainly would use iwoca to help me and help my clients. And Xero is very much part of my management information system and key to it, in fact. And that will be, in fact, the message I will be imparting is that management of your information is the most important thing in cash flow. Thank you.
Thanks, Niall. As always, good insight. We'll touch on that more in a moment. So just to start the webinar, let's just jump into a couple of polls with a couple of questions. If you can make the magic happen and get these to appear on screen for me. If you could please just select, one of each on the polls there. So first question is, how much are you currently owed by your customers? So, everything from nothing, you mean you're totally on top of everything cash flow related, all the way down to anything over 50K. And then finally, the second question, which is, do you currently rely on debts to support your cash flow? So are you using things like your overdraft, short-term loans, extended supplier terms, etc.? Just let that run for a few seconds and we'll then pull up the results. And panelists can't vote, by the way. So I don't know if we want to try and show the results. I think they do update in live time if people are still selecting. But if we could show the results. Awesome. Okay, cool. So quite a few people, obviously, that are over the 50K. Showing that will obviously be typical of the demographic of the call today. Quite a few, obviously two out of the 15% there in terms of nothing at all, totally on top of it. Definitely in the minority from what I see as well. And a bit of a split between using sort of debt to support cash flow in the business. I mean, Matt, I'll probably come to you on this one because you probably typically see this more than anyone else on the call. Does that kind of fit in terms of what you're seeing in the market at the moment?
So I actually looked up, so I went from 2 upwards, in an ADHD way. 54% of people saying that they're using overdrafts. That fits pretty much perfectly in line with industry numbers. So small businesses, typically you'd say around 55% of small businesses will consider and will use debt and lending of some description. And then there's about 10% that might consider it, and about 35% there or thereabouts that will say they'd never take debt. So those numbers are bang on as to what I'd expect. The currently owed actually surprises me. So that's larger than I consider. Obviously, I don't know the size of the businesses and the owners on this call. Typically, we'd sort of see that being around 25 to 50 as an average range for most small businesses. But then with small businesses, that's a very broad term. SME covers everyone from a one-man band through to, sometimes up to 200 employees. So it's a big range. And if we're talking over a 500K, a million turnover business, then that 50K number is nothing really, isn't it? So it's it's a bit higher than I'd like to see it. But then there's a lot of stuff that we can cover as we talk in the call. As to why we're seeing that at the moment. It's not a cheap time to be in business.
No, thanks, Matt. I think it's all relative, right? These numbers, they just give an indication of where that control's kind of sitting. I think for me, it was the second question that really pulled it out there for me in terms of those numbers and the insights that you get. That even when you are no, there are different types of no in terms of being on the fence, a definite no, or there's potentially used different mechanisms as well. So if we can close the poll down, I don't know if I can do that from my screen or not. Let's carry on. So a stat that's not really moved in a long while is that around 80% of businesses fail due to cash flow issues. Now, this number can rise even more if you just focus on the smaller end of the scale. I think Kat will talk about some stats in that sort of lower SME sort of space in a moment. Now, you might say that's quite obvious that you're going to fail because of cash flow issues. But if I said that around 70% of those businesses were actually profitable, it's a totally different conversation. And that stat itself becomes quite frightening at that point. But yet the data suggests that only around 14% of SMEs actually use cash flow tools. And many of them rely on spreadsheets, which are inherently out of date, prone to error, or just by managing by what's in the bank. And, as Niall talks about, this is where the advisor absolutely adds massive value in these conversations. A lot of the time after the event, and sometimes when it's too late, hence why this stat is so high. Kat, I suppose if I move on to you now, and I'll throw up your slide in a second. If you could just talk to us about some of the stuff that Xero has been doing in space, and looking at this term unapproved debt, as well as the other stats.
Yeah, perfect. So Xero's been doing quite a lot of work in the background with the government, just around changing kind of the language and the culture of debt for small businesses. It's such a massive kind of issue that they're having at the minute. So we've been having conversations, and kind of there's different pillars to the small business manifesto that we're building. So one of them is, like I said, changing the culture and the language so that actually debt that's out of range of your timescales is actually called unapproved debt, actually calling it what it is. It's not approved debt, it's unapproved, and that's what we want the government to kind of change around it. Also, one of the pillars of that manifesto is kind of holding bigger businesses accountable for the debt that they've got for smaller businesses. So some of the stats here we've got, obviously kind of concentrating probably more on the smaller scale, but 90% of those businesses have issues with cash flow, and the businesses fail due to that. A lot of them can potentially be caused by large businesses holding that cash back. So what we're trying to get is obviously those stats coming down massively, because that's such a large chunk of those small businesses. But also, like 34% of small businesses are experiencing late payments, say that they have to rely on those overdrafts. That's not what we want either, because they're going to feed into that 9% of businesses. But I think a lot of the stats on here is talking about like the financial implications of it as well. Part of the work that we've been doing is actually talking about the mental work as well with the small businesses. It's very much people focused, and it isn't just the financial strain that they're putting on people, but it's also the health of that person, their family, and the surrounding people that are working for them as well. So 1 in 7 of small businesses say that they struggle paying their employees due to issues with cash flow. A lot of the time as well, it means that the person that's actually running that business isn't taking wages from that business either, because they're the first person that's going to suffer if they're struggling with cash flow. So it's kind of taking all these things into account and going to the government with this and kind of putting a face on it and saying how much of an issue it is for small businesses. So that's a lot of the work we've been doing in the background. Obviously, quite a lot of these stats here we've got from some reports as well that we've been doing, which we can kind of share after this webinar, which is really... It's a scary read, but it's also good to kind of understand what's happening in the world and the changes that we're trying to make to support those small businesses.
No, that's great, Kat. I think I've obviously been part of this for a long while now, as you've been lobbying this with the government. I think it's an amazing initiative, and I think like you don't realise the knock-on impact into that sort of supply chain and how it cascades down to businesses. When you are withholding payments and things like that as well. So I mean, that's great. If we could also have a copy of that and maybe share that with the slides and the recording as well afterwards, that'd be great insight for the listeners today. So we've broken today's discussion down into 2 sections. So what we class foundations and then insights. And obviously, without proper foundations, it's more difficult to develop and rely on insights. So we'll take you through each stage. We'll sort of discuss it and talk about the different components and where technology can also leverage insight as part of this. So if I start at the very bottom, and this is often overlooked, unfortunately, by a lot of business owners, is invoicing. So basically, how we turn whatever we do it is into a payable invoice or a point of payment. But before we look at the invoicing itself, like Cat Stats, that's a new thing now. It's going to be Cat Stats. I want like regular segment on this. Brought some of this to life for me is that sometimes, like, should we be looking at as business owners our customers and whether we should be doing work for them. And Niall probably pulls some of this out in his FD role with, you know, his clients, is that, you know, looking at things like red flags, like credit checks, company's house information, current outstanding debt or previous history of late payments. I used to go through all of this with my clients as well. And this is just a component before you actually do business with somebody or you do more work to raise that invoice. The other thing I used to look at quite a lot was over-reliance on single customers, which for small business, although it isn't necessarily a cash flow concern, it is a business risk. And these are sort of things that you overlook too easy at that very early stage of business, because you just want to sell your product, right, and make some money. So we're going to talk about raising invoices, and I'm going to lead with Kat on this one from a Xero perspective. We'll talk agnostic anyway, because these things are fundamental in any finance function that you are using. But often invoicing is raised late, it's after the event, it's then deprioritized by your customers. And also for me, the biggest bugbear, and I get invoiced this way for certain things, is that it makes it really difficult for you to actually pay them. And then we'll talk to Matt about that afterwards in a moment. So Kat, how can we use accounting software to make this process easier once we've thought about all the stuff I've just talked about?
Yeah, no problem. I think it's I mean, like you say, invoicing is that first level of kind of where you want to start. So there's lots of different things that we can do. Obviously, taking it into a digital environment is kind of step number one. I think at the minute, if you've got any kind of manual process into your invoicing, again, it just kind of delays you getting those invoices out. So first step, get it into a digital environment. Obviously, Tay's a little bit biased on Xero, but there's plenty of different softwares out there. The main thing is getting it into that digital environment, so it's getting sent out quicker. So actually making that switch, and kind of not being scared of that switch either. I think sometimes when people have had manual processes before and we're getting into that digital environment, it can be a bit of a daunting task. I think just knowing and trusting your advisors that actually that is the way that you need to go and it can help you. I think just try and embrace it as much as you can and make that switch to that digital world. Make sure
you talked earlier about that sort of people impact in terms of getting time back and the stress on the business owner. There's nothing worse than a business owner spending their weekends and evenings away from their family raising invoices. So like I used to advocate to all of my clients to invoice regularly as quickly as they could from point of sale using the software. And you know, things like mobile apps as well make it so much easier to do on the go. So there is really no excuse anymore. It is just making it a habit, right?
Yeah, I think so I grew up with, my dad's got a small business, he's a builder. I kind of grew up with my Sundays sitting in the office with my dad. He wouldn't touch a computer. I'd be like raising all the invoices on a Sunday. We'd then go for a drive round and post them through to everybody's houses. And it was just, that was my weekend as a child growing up. Whereas I think now, don't get me wrong, I still do his invoices, but I do it from my house and I'll do it immediately as soon as he's finished a job, and then he's getting paid quicker rather than kind of waiting all that time. So waiting until you've got time to do it, spending your weekends and time doing it, and then having to even start chasing those invoices as well. It's time just being taken away from, like, there's that work-life balance, isn't there? You work to live, not live to work. Like, that's the kind of thing that I think with this, like, using digital as much as you can to get that time back for yourselves, I think is just key with all of this.
No, 100%. We got a few more slides here, but I mean, obviously more talking points here. So obviously using the system to its fullest, as we talked about in the intro, just going through those payment terms as well is obviously vitally important. You talk about unapproved debt. Obviously the payment terms are significant to that unapproved debt term, right?
Yeah, I think, and as well, I think it's using payment terms. I think sometimes people can be a bit not scared of using them, but they don't want to come across too harsh, or they don't want to put payment terms on them if they really like a supplier, or kind of letting suppliers get away with not sticking to payment terms. So I think from the outset, using payment terms, sticking to them, even if you choose different payment terms for different suppliers, like one supplier you might know, actually, I need to wait a little bit for that payment, or actually they'll come back sooner. So making it bespoke to the supplier that you're working with, definitely, but always making sure that you have those payment terms there so that you have something to go back on and say, actually, that is now an unapproved debt because I gave you the payment terms. We agreed to that, but it's now over it. And kind of making sure that it's having those conversations as well, and not kind of being afraid to start those conversations with people. I mean, suppliers know when they're out of those payment terms, like it'll be flashing up red on their systems. They know it's there. So sometimes it's just making sure that you're putting them on and using them as much as you can.
When we're using the technology right, like we can set those credit limits on those suppliers. So every time we're looking to raise invoices and do work, it will then tell us what the credit limit remaining for that particular customer is. And again, areas that I see people underutilizing is these very basic functions, but they add so much value in terms of you understanding how you're running your business. We talked about those reminders, and you sent, going out and posting these things through the post and things like that as well. But obviously, automating and using these reminders as well will obviously massively help you get paid. And a little trick I used to do as well was immediately send sort of like a reminder very shortly afterwards, just to say that hope you've received the invoice, etc. And by the way, this is just a reminder, there's nothing about it. And then you go into your sort of payment terms chase there afterwards.
Yeah, there's kind of like, you can put like preempt it. So yeah, you can wait until after that debt's due and then you can start chasing it. But also you can just send those little reminders of this is coming up in 7 days, this is coming up in 14 days. Like kind of be preemptive to it, but then also chase it up afterwards. But I think the key bit on this is automating it as much as you can, because I think sometimes when you've got your own business, you're so busy in just the day-to-day of that business that kind of like chasing in these debts is kind of at the back of your mind. You know you need to do it, but it's not a process that you want to sit down and do. So within, obviously, quite Xero focus, but within Xero, there's certain elements of it that I definitely kind of recommend using, like the invoice reminders. You can set them up and they're just automatically running in the background and you don't have to be constantly thinking about it. You can phrase them the way that you want to phrase them. Change the phrasing of them so it's like a nice gentle reminder before, can get sterner as the payment terms kind of go on and on. But yeah, just making sure that it's just going on in the background and you're not having to spend time on that debt collection side of it.
Yeah, and you used the word debts there several times, which brings us nicely onto this slide, I think.
I think these stats, so when these stats first came out from a report that we did, I actually thought it was quite shocking, because when we talk about kind of how using software can make debt easier and kind of get those collections in sooner, I kind of didn't think the stats would be as strong as they are. So from the data that we pulled across the range of small businesses we spoke to, 57 is the average debtor days where they're not using any kind of bookkeeping solution. So 57 days is quite a lot. But then you think they're not using any online bookkeeping system, like there's no automation going on with it. So you think, all right, okay, fair enough, that seems okay. But then if you look at it, when they're actually using a bookkeeping system, but no payment solution, that's almost halved. So just by putting your work into a digital environment, you're halving those debtor days. Then when you start adding in a payment solution, so for anybody that's on the webinar that isn't certain what I'm talking about by a payment solution, within Xero, you've got the option to have a pay now button. So when you email an invoice out to somebody, it has an option for pay now. You can click on it and kind of pay directly from that invoice. So just by adding that one little feature onto that invoice and giving people the ability just to pay directly from the invoice that you sent them, that actually brings that debtor days down to 10. And I think sometimes we kind of don't appreciate the way that the world's moved. So everybody's on the phone all the time. I know that from setting up a million builders now on Xero, that if they send me an invoice and it comes from Xero and it has a pay now button on it, I'll immediately click it and pay it because everything's set up on my phone and I know that I can do it within 2 clicks. If somebody emails me an invoice that then I've got to go into my online banking, type in the details and pay them, that's definitely a later job for me because I've got to sit down and do it. So I think just appreciating how much we can kind of get those debtor days down just by like literally a pay now button on invoices just can have a really big effect on that.
Yeah, it's crazy. And those stats are kind of in line in terms of the sort of impact that I see in practice. And I would say the average debtor days there when not using a solution, let's be honest, nobody's payment terms are going to be 57 days. So that's highlighting that where they don't have that is in excess of anybody's payment terms, even if you're, 30 days at the most. And I do find, I always use my stats with Matt the same. And I said, when I've used payment now buttons with Xero in the past, it's always about a third faster to get paid. And that breaks down quite nicely in terms of that third, which brings us quite nicely onto the next stage, talking about that payment collection piece. So Matt, we talked a lot about previously making it easy to get paid as a key component of improving cash flow, whether it's pay now, pay later. But can we just jump into sort of like from the iwoca side, the insights from iwoca, and talk about those benefits of adding those payment solutions and options to get paid, and just sort of show us, where iwoca kind of sits in that payment process.
Yeah, certainly. Just touching quickly on Kat's stats there as well. I'm going to use it as well. Sorry, Kat. The 57 days actually lines up perfectly with another stat I think Xero's come out with, is that the average sort of late payment is about 26, 27 days. So if you are talking about the standard 30-day terms, that's a horrific 57 days, 2 months after you've done the work. And any business that's not got any cash flow for 2 months is really in a dire strait. Where iwoca comes into things, and the details and the data that we've got shows that similarly, adding on an online payment method to your invoice, so in this case, say a Xero invoice, is going to be between 2 and 4 times faster to get paid. So sort of sitting perfectly on that third time. We ourselves see over 75% of an iwoca Pay payments going through on the same day. So that's when someone clicks on the invoice and comes through to the iwoca Pay checkout, they're going to get paid like 75% of the time on that same day. So the basis of iwoca Pay, iwoca, our 12-year trading small business lender. We've facilitated loans now to over, I think it's 100,000 small businesses across the UK and Germany. And we brought out iwoca Pay in 2020, fast-tracked its release effectively when the coronavirus impact was realised. So in June 2020, we released iwoca Pay, and the whole concept is exactly that, is speeding up payments for small businesses. And it's giving your end customers more ways to pay through a simple setup for yourself. So nowadays, where you've got the likes of PayPal, Klarna, Pay Later, Shop Pay, debit card, whatever you want to have, if you've got too many options in some respects for your invoices and for your checkouts, iwoca Pay tries to simplify that by, similarly to the Xero solution, offering a Pay Now button, which means you can get paid in 3 clicks. So it just automates everything through your online banking for you. We power that with open banking, so it's an entirely free to use solution for all parties. But we also implement a Pay Later feature. So we're using our technology and our sort of lending arm to be able to credit assess your end customers, and they can then choose to take payment terms with us, with iwoca. Again, no different to taking Pay in 3 with PayPal or Pay in 3 with Klarna on a consumer side. The difference being this is dedicated to limited companies and trading businesses. So you can take terms on your business. The supplier gets paid on day one. They have no credit risk. They have no recourse on that payment. The debt sits solely with the end customer. And the whole concept, and I think Niall might mention a bit later, sort of facilities such as invoice discounting, invoice financing, spot financing, where the supplier takes the debt and takes the obligation on themselves by freeing up cash flow through their overall ledger of outstanding payments. But this solution is designed to counter that in a way and put the emphasis on the end customer being the person that, if they choose to, they can take a credit facility, and then the supplier still gets paid on day one.
Yeah, no, makes total sense, Matt. I think I've seen huge impacts with just adding a very simple Pay Now button to clients in the past, and even when colleagues in my previous firm had invoices raised by said clients, they were sort of like, all of a sudden, I got this invoice, I clicked this, I paid it now. Is this one of your clients? I would say yes, and then they would say, well, I didn't realize that was a thing. I was like, well, why wouldn't you do that for your client now? Like, you've just seen my client get paid literally while he's sat in his van, just left your house. He's raised the invoice on his phone and you've got that invoice and click Pay Now. Like, why would you not do that for your clients? And I think too many businesses probably aren't, like I say, using some very basic feature enhancement of their platform. So that's why we like kind of start to build these things up in layers. And that's what we like to do with our clients on our side of the fence as well. Niall, Matt touched upon there, like these are areas now where we as advisors add value to our clients. What kind of other areas do you kind of start talking with your clients about at this stage? Because this is still very foundational, right? In terms of how they run their business and how they, I'm not going to say collect cash, but, you know, facilitate revenue in the business.
Yes, thank you, Russell. So first of all, you know, CAT and the software industry have saved the accountancy world because they've actually made our job easier, i.e. they've automated a lot of the grunt work. And it's very important. And I mentioned earlier, information is king. It really is, particularly with cash flow and cash flow problems. And iwoca have also helped give us the time for some of the issues that cash flow problems create, and they've given us the time to actually work through the problems. So I want to thank those guys. And then basically this is where we come in. We come in because we save our clients money. Of course we charge fees, but the reality is it's a value-added service. And what I mean now is that I can save a client a significant amount of money by effectively helping their working capital cash flow. And it sounds very simple and straightforward. The statistics that iwoca, and rather Xero, have presented clearly show what we can do. So we can help the client actually digitalize, fine, that's straightforward in my opinion. But second of all, we can give them the advice. And the advice is very simple. Implement the credit policies that you already have, that you already do. So that could be 30 days and hopefully no more. But the problem we find is that most businessmen, most SMEs don't actually apply the credit policies that they already have. And it is a statement of mind. So what we do is we take that over, perhaps. We would say, let us become your credit controller for a while. And also, why don't you in fact do simple things like ask for payment up front, ask for some of the payment up front. I mean, yes, you're selling your product and you think, great, I've managed to do a sale. But the reality is, if they really want your product, they should be happy to pay for it. They should be happy to pay for some of it up front, particularly if you're working on a cost of materials upfront, and that's your costs. So, you know, a very simple calculation. If you're charging 6% a year, which actually is quite low, it works out at a £50,000 debt. You're actually saving yourself 250, or it's costing you £250 a month, effectively, £58 a week, or whatever it might be. You know, that would be the cost of employing an accountant for a month, and then you'd have that 1 month cost, 1 month saved, and then happy days, because we can reduce the debt significantly by mentoring you and by creating the conditions, i.e. the information flow, to give you the reasons for you to reduce the problems that you have. For example, the next thing I would say is, why work with customers who don't pay? I mean, these are simple, straightforward solutions. They're not to do with accounting, to do with business, but that's what we are. We are business mentors. And that I would say at this point.
Yeah, no, that's great. It's great insight. And I think that whole idea of invoicing up front or interim billing and stage billing and all that sort of stuff, businesses are scared to do. But there are certain professions or certain industries where it's just the way that they do business, right? If you're on a cost of materials type basis, like you say, especially with like building and stuff like that. So when we had extension put on a house, it was 30% up front before they even start the job. And then by the time they've got to whatever stage, it was another 25%. And then it was the balance on completion. Like, I had no problem with that, because they need to go out, they need to get their materials, they can't cover that cost all the way through to when I pay, and then rely on the fact that I'm going to pay them when they want payment and not delay it past their payment terms as well. So it makes perfect sense. And I used to have a lot of big wins with when I used to have clients in just doing simple things like, why can't you invoice 50% up front? Just asking questions. It's all about asking questions, really.
It is. And I'd also say, if they're not prepared to pay 50% up front, or even anything up front for something that is justified, then really what's going to happen when you give them the work and they don't pay? Because that's a likely outcome, unfortunately. And it costs you a significant amount of money. Exactly.
That's an excellent point. The final stage of our foundational considerations here is, we've talked about cash inflow. So turning a thing into an invoice, into a payment, and getting cash into the bank. Obviously, the other component of cash flow is what we're actually paying out in terms of expense, and using technology here to make sure that we're capturing all of the expenses on time, to make sure that we are, I suppose, maximizing tax deductions. Obviously, we're not missing expenses that are sat in the footwell of our car or left in an old pair of jeans that goes in the wash or something, but making sure that we're picking up things like invoicing dates, payment dates, and this expectation from our suppliers of when we're going to pay them, because that is the other component of cash flow, is when are we going to get paid and when do we need to pay others? And going back to Kat's stats, this is now a thing, Kat, earlier on, is this has a knock-on effect down that supply chain. So by us not being prepared and planning forward with our expenses as well, we can very quickly and easily, and Niall see this day to day, right, is run into cash flow problems by not forecasting our debt forward. Our own debt forward as opposed to what we're due back in the business. So we'll use things like data capture tools. Again, we'll make it really easy for our clients to build a very basic foundational tech stack here to get good foresight and data on their business running forward. So this kind of takes us to that foundational stage. We've probably touched around a lot there, but in terms of things like, Niall, I'll come back to you again on this one, in terms of those conversations with your business owners, the other thing that we suppose didn't touch on there was, I think Kat did mention it earlier, was the disparity between our credit terms and our supplier credit terms. And especially if we're looking at things like interim payments and that, it's, I suppose, understanding that gulf between when we're going to get paid and when we're expected to pay our key suppliers.
Yeah, that's actually a very good point. I mean, again, it comes down to common sense. If a supplier that you're dealing with is asking for 30 days, then and you're not paying him for 30 days, maybe that's something that you need to address as well. The point is, though, you need to do as you do to others effectively. That's probably the number one criteria, I would say. But in terms of creating the information flow, I mean, that is also extremely important, because you need to understand what your debt is likely to be. You need to understand the future of your business, and that's always looking forward. And to do that, you need the data the historic data, but the historic data is past data, and then you need to understand the future, and the future is what your future sales will look like. And that's actually a big problem for a lot of my customers, because they say to me, how do I know what's going to happen in the future? Well, the first thing you say, of course, is, well, you know what's going to happen with your costs. And they go, of course. Well, there you go. So at the very least, you know that you want to match your cost base. So there's your first sales revenue line in the cash flow. And it is about building that up, building up the confidence and learning from the information that you do know. So it's about understanding what you do know, not what you don't know. And that's something that we obviously will step in and help with and give the confidence, I think, for the average SME to actually not worry about the day-to-day cash so much, because they know it's under control. They can then do what they do best, which is sell more and improve their products, which will, of course, sell more, and look after the customers, which, of course, will sell more. And that's what creates the cash flow. Yeah,
no, definitely. I think it segues quite nicely into, I've just pulled the next level up, is that first stage of insight. And I think you said there, without delivering the exact quote, is how can you predict the future is ultimately by looking at the past. So how do you develop sort of foresight on historic transactions? Is like create a budget, right? So once you've got a budget, and again, it's something I think is massively underutilized. New businesses starting off, they go for a business loan or they go for finance. They need a budget, they need a forecast, they need a business plan. When you're in business, most of the time that budget falls by the wayside. So like from your perspective, Niall, at what stage of the business life cycle do you think, it's probably a bit of a loaded question, right, is when should they really have or benefit from a budget, and are we actually seeing it being implemented in reality?
Okay, well, the first place I'd look for is that famous show with Sir Alan Sugar with The Apprentice. And if you look at the semi-final stage, where all the candidates, and it seems to be a repetition every year, they fail on the budget, they fail on their plans. They either don't know what their plans are or don't understand them. But the point is they don't use them, and they all get castigated, and they all say, well, how silly we all are. But actually, there's an interesting lesson there, that people underestimate the value of budget. The first thing you've got to do is you've got to, as I say, you know your costs, and then that gives you your revenues. And if you're not going to make a profit, why are you in business? Well, of course you're going to make a profit, because of course you're going to have to sell more than your cost base is. And so that gives you the first and most important, I think, idea of any business. And it also allows you, so the point is you do this almost first thing. It allows you the ability to plan your staff. You know, how many staff will I need to supply the service, to make the product? You must know that, because if you don't know that, you shouldn't be in business, obviously. And the point is, you then work out what your rent is and so on and so forth. And then you work out what your customers are, where your customers are. And by doing that and putting numbers to that, that will give you exactly what you need to go to a bank, to get a loan out, to go to iwoca, to understand where, you know, what you need. And then, of course, if you've been trading, and maybe you have had some experience in trading, and looking at the historic data, that gives you the confidence in the seasonality, gives you the confidence in how quickly customers are paying you, I should say. And of course, that goes back to, well, what can we do to improve that? But the reality is, I think, you know, if you don't have a budget, you can't plan ahead, you can't pay your taxes on time, you then worry and stress about it. And in fact, if you had a plan, even if it didn't go to plan, well, then you know what you need to do to get to plan. The point is, you're doing it by numbers, and that is important in any business, up to a point, of course, up to a point. But that's where accountants and advisors can really help, where it's really valuable to pay a little bit upfront to get that information.
Yeah, that's great. It's great points. And Kat, obviously, if we're looking back and using things like Xero, data that already exists in platforms, it's so easy now to create these budgets because we've got all of the information at our fingertips, right?
Yeah, I think for me, like, I don't see budgeting as kind of a one-off thing. I think it needs to be something that's worked on in real time. So creating a budget, but then also not wait until the end of the year to track that budget against what actually happened and then think, oh, it didn't quite go to plan, let's plan again next year. It's actually having your data always up to date so that at any point during the year, you can check how you were forecasting against your budget. Do you need to make changes? And like creating that agility within your businesses that during the year you can make changes so that you're hitting those budgets. I think sometimes like businesses have just fallen into the track of kind of creating a budget because they needed to create a budget, they needed to do the cash flow for like getting finance, and then kind of forgetting about it for a year. By that point, there's no changes that you can make. So it's just making sure that kind of if you've got a software in place and you're raising your invoices, you're doing your expenses kind of in real time, use that data and actually check how you forecast into budget, use the reporting kind of as you're going through the year, and just making sure that you're kind of keeping on top of it all the time and just having that full visibility so that you can make business decisions and more informative ones with the data that you've got already.
Yeah, that's great. I think, Noel, you kind of said it earlier on that it's all right if you don't meet your budget or you fail your budget. And the thing is, you learn so much more from failing something than by not failing. So if you don't have that budget, you're never learning the areas of your business that are maybe subperforming or not meeting your expectations and things like that. So just having something there at the very start is something fundamental. But you're right, Kat, being able to keep on top of that and refining it and looking at it as you go along is absolutely key. Now, most of the time, budgeting ends up being reactive, I would say. People just do it once at the start and then they go, oh, did I meet budget, didn't I? But if we look at forecasting, particularly then at the cash flow side, this starts then providing us with that more proactive view. We're taking all of the data that we've pulled together in the foundational stage there. We've got our sort of inflows and outflows coming through the software. And again, we can use software, we've got Sift in the business, but there are many other platforms out there where they pull and aggregate all this information from the underlying software and enables you to very quickly get to a position where you've got a base to start manipulating the data and building different scenarios, whether you look at large pieces of equipment or opening new locations or taking on new staff and things like that. So rather than just going into the details of like the cash flow itself, and I think Noel and Kat both touched on this within the budgeting side anyway, of how important it is to have both. I just want to flip it around the two considerations around cash flow. And Matt, probably you first in terms of that negative cash flow piece. And we had the stats at the start, which was just under a 50-50 split, where a lot do rely on debt and short-term debt to ease cash flow pain. In terms of what we're kind of seeing in the marketplace in this, I'd probably say post-COVID, current economic climate era, through what you see at iwoca. Yeah,
certainly. So to give a bit of context and to sort of help in the understanding of what we're seeing now, it's useful to look back of where iwoca came from, really. So we're, as I mentioned earlier, we're 12-year trading business, and came out of the back of the economic crash back in 2009, wherever you want to call it, 2007, 2009, the housing crisis. Christoph and James, the co-founders, effectively came together from 2 wealth management companies and decided to, well, one, that they could see a gap within small businesses, that they weren't being adequately supported by incumbents, high street banks and bigger lenders. And 2, that if they were starting a business, it would be great to have had an iwoca in the past. So while they were building us out as a business to provide simple cash flow, like the name iwoca is instant working capital, they built the idea around the banks weren't lending small businesses. Similar situation we're seeing today. Post-COVID, the banks have got a large debt from bounce back loan scheme, from the coronavirus business interruption loan scheme and recovery loan scheme, all the British Business Bank backed government schemes. The banks were moving more to medium and large enterprises as being safer bets for lending and more profitable for them. Again, a very similar situation is happening in the current economic crisis climate. Sorry, lots of acronyms are really throwing me this morning. So what we're seeing at the moment is, yes, we are seeing an increase in applications and businesses coming to us for lending. Our forecasts, so it's very interesting, the sort of topical nature of budgeting and forecasts. We've got around 100 analysts within iwoca, so we're about 420 now. 100 of those work within our sort of analytical and product teams and are constantly modelling, one, what we expect the market and the demand for iwoca to look like in the short, medium and long-term future. But equally looking at, as you'd expect, we are a lender. We have money and capital outstanding to the borrowers and the customers that come to us. So we need to understand how likely that is that it's going to come back. I mean, are we going to get paid ourselves? And it's a small business problem, but on probably a bigger scale, because that's what we focus on. But it definitely goes through this whole flow without knowing what the money is out the door and where what we're owed and what's going on. We can't then forecast for the future, and we can't then continue to support small businesses. We're fortunate now that in 2023 we reached profitability ourselves as a lender, which is, you know, a sort of gold standard for any kind of fintech, but especially in the lending space, in that we're now able to fuel our own growth and put more of our own cash into small businesses and supporting their cash flow needs. Yeah, it's an interesting environment. There's definitely, to end, I'll just say the one thing that we're seeing the most of in the current climate is that there is an aversion to pricing and to the cost of finance at the moment. Some has come on the back of the cheap funds that were available through bounce back loans and civils and RLS, the recovery loan scheme, and some with obviously the cost of everything else in the current economy. It's making people more conscious of where they're taking on debt and where they're investing their time and their efforts, which is where people like yourselves come in. Niall, especially Russell, yourself once in a while, but in
very nicely into
advising businesses.
Yeah, no, exactly. And I suppose this was here just to highlight exactly that. You've got the foundations in play, you've got everything that you need to budget and forecast within your business. And I think, as Niall's demonstrated through the conversation all the way through, the bit that really supercharges that is the supportive advice from your advisors. So we would wrap all of that together. And, you know, at Gravita, we do everything from building the components of this up from a technology perspective through the business advisory, and then in sort of more Niall's world, that sort of quasi sort of FDFC type role within those businesses. In terms of the webinar itself, just very quickly, so I wanted to touch on here, like AI obviously is a big component of all of the technology that we just talked about there. I think maybe just like potentially like Kat, from your perspective, like with the Xero world, you obviously announced your sort of AI Jax recently. So how is Jax going to help us or help our clients in this space?
Yeah, so Jax is at Xero. Absolutely love acronyms, but it's just Ask Xero. So what it is there's going to be AI kind of embedded into different areas of Xero going forward. There's going to be more releases on this around June time, where it's going to be you more practically be able to see it. But there's going to be the ability to kind of automate a lot of tasks within Xero. So say, for example, the bits that we talked about today, invoice reminders, setting up invoices and things. Actually, the ability to get the AI to generate these for you. And just also there's going to be more embedded into the cash flow systems in Xero. So if you've not had a look at Xero's Analytics and Analytics Plus, there's going to be more that comes on this going forward, but that's the way that we kind of want to use AI, is to support with the cash flow. So I say a lot of the work that we're doing is helping small businesses have more insights and understand that cash flow, but also easily have it accessible and be able to view. So all the AI features that are going to be coming are all kind of within that remit, are all within helping the generation of invoices flow through quicker and easier with more automation and less manual processing, then also making sure that that feeds through into the cash flow reporting as well. So there's going to be a lot more coming about it soon. I feel like that was like a little bit cryptic about it, just because we can't practically see it yet. So there is a really nice video that talks through it all, which I can also give kind of the link to after.
I think we've all seen the video. We want to see the product, I think. And the AI side, right, just highlights the importance of getting all of this stuff done correctly, structured right in the platforms, because there's lots of in-platform AI being developed at the moment and released. And you really get the benefit and optimize that if you've got all of your data in the right places, using the functionality to its fullest, and then AI will just enhance that going forward. Now, we did promise 3 tips to implement cash flow within your business as part of this. So I've broken it down into 3 sections. First step should always be, as we've covered off today, review your current processes and understand what and how you do things currently and where improvements can be made. We've talked to you through all of the different foundational levels, and also in terms of the processes and platforms that you're using, because looking at your processes should highlight areas where you can make improvements, but also highlight areas where you are currently not utilizing or benefiting from technology adoption. One of my top tips in this review stage would be speak to those doing the work. So if you do have a team with you and somebody's on the sales ledger, the purchase ledger, the bank rec, the whatever in your job, in your business, do speak to them, because I tend to find the people doing the tasks do them totally different as a business owner than how you think they do them. So understanding what's actually going on, where there are pinch points in the process, or where the technology potentially isn't doing what it should be doing, you get that from just having that collaboration. So the first step always would be review where you are today, and then ultimately over that, lay that with where you want to be in the future. And again, always good at this stage to speak to an advisor as well. Refine those processes. So once you've understood what you do, refine how you do it through process improvement, training, reworking, and then using technology as an enabler for that. But from the technology side, if you understand what's being used currently and optimize its functionality, as we talked about, large components of things like Xero and underpinning technology, look at things like other integrations. We talked about a very basic tech stack today. There's so many different apps that we could use to fix pain points for clients, but today we've obviously kept it simple. But where those integrations and automations will help, trust me, there's nothing worse than trying to fit an old process into a new piece of technology. So don't use your old process in your new way of working. Review and optimize that at every stage, and it'll give you the best foundations. My favorite part is when you're looking at a technology partner, I've always used this formula in my head, and it's always done me pretty well so far. So first, look at the problem that you're trying to solve, because lots of technology vendors will sell you the dream and tell you they'll fix all of your problems, but you need to understand your problems first and foremost. Then find the product, and again, speak to your advisors, your accountants, because they should be able to help you and guide you in this area, because they'll see technology that works in lots of different ways and works best in different sort of areas. So look at the products available to you. Do they fit, and do they solve the problem? If they don't fit all of your problem needs right now, is it on a roadmap as well to meet those problem needs? For me, the biggest one in this first step is the relationship. So can you work with them? Do you get a good feel from them? We've got 2 of them on the call today. I would say I get on with them fairly well. I trust them. If I ever need them, I can pick a phone up, I can WhatsApp them, etc. Can you get that feeling from your vendor relationship that they are there to support you in your business, or are they just trying to sell to you? Pricing obviously does come into it, but for me, I deprioritize it at the bottom of my 4 steps, because yes, everyone wants fair pricing, but at the same time, are you throwing sort of people at a problem? So it's costing you inevitably a lot more to hire people than it is to use technology, but people get fixated on a monthly subscription cost as opposed to the actual time they're losing in their day job by not doing their sort of task properly. So pricing should be in there, but I would never put it at the front of that conversation. And then finally, the value. So can they give you valuable insights like the guys I've on the call today, provide you with support, get you from a novice user to using their platform really well, optimizing it, give you the training and support that you would need. And that for me is the formula that I've stuck with probably for about 10 years now. And it's always led me down the right path. So I'm giving that to you as part of today's webinar. And then finally, embed it. Don't throw any new change in process at the business and hope it sticks. As Niall started talking about, embed it into refining those budgets ongoing. Keep looking back at them, reporting out on your budgets. And then in that cash flow, not just leaving it static, because the cash flow should be live in your business. Look at that, evolve it over time, and make sure that it's actually being used and delivered. If it's not, hold yourselves accountable, and make sure that you are creating good habits for the future. Finally, obviously look for support. When you are taking advice at each stage, at the very early stage, Niall phrased it quite nicely actually earlier on. It should be seen as an investment, not a cost. And ultimately, if you have the right advice up front, it saves you more money than that advice in the long term. So I would overlay all of those steps with, do take support in terms of understanding your process, your needs, your wants, understanding the technology and the software, and where that wider ecosystem could benefit from you as well. And also helping to hold you to account to all of those steps that we talked about a moment ago. Just some of what we offer and what our clients do. As with any webinar ever run, I think, we've run into probably pretty much time in terms of for questions. However, any questions that are in the chat, we will get back to everybody and respond to them. So I don't want to try and shoehorn a really rubbish question in now, and then try and get an answer from the team. So I think what I'll leave us today on is to say thank you for your time today. I appreciate it's taking an hour out of your day to join the webinar. I hope you got some really good insights and takeaways from what was discussed today. Obviously, I'd like to thank the panel for joining today and providing their insights. Kat obviously was in an award ceremony last night, so she might have got back a little bit later than the rest of us. But if you did want to reach out at all, all of our websites, our LinkedIn connections are all here as well. If you do want to reach out at all, and like I said at the very start, there will be the recording available, the slides, and some of Kat's stats and insights will also be shared as part of that. So thank you for joining. Thank you, panel, and have a great rest of your day.
Thanks for having us, Russell. Thanks, everyone.
Thanks, bye.
Thanks, guys. Great webinar.